Yo, what's going on, my brother? I wanted to break down the candlestick patterns that I like to look for whenever I'm trading my real highs and my real lows. I know you messaged me this morning asking me for help on what I do whenever we're seeing price moving out a specific way. And kind of maybe my confluences that you might not know that I do whenever I'm trading in the morning. So there's basically six, one, two, three, four, five. Oh, there's six candlestick patterns that I look for. And I'm going to kind of show you everything. Now, before I kind of go in depth, all of this is in the Candlestick Bible. If you need the Candlestick Bible, again, let me know and I can send it to you. But the first candlestick pattern that I look for whenever I'm trading at my in the morning, whether it's bullish or whether it's bearish, is I'm looking for an engulfing candle of my real high or my London high. Now, basically, a bearish engulfing, I have here notes, it usually comes at the end or at the top, sorry, of a bullish trend or off an all-time high. So if you're trading an all-time high, if you're trading, a bullish high in a nutshell, or if you're trading an overextended bullish market, this is a candlestick pattern that you want to look for. So obviously, in this specific example, we see candle here, candle here, candle here, and candle here being created and being printed. Now, after we created technically here a shooting star pattern, which I'll show you another example of, we had us print this massive engulfing candle here that engulfed all of this dynamic liquidity here. And what you want to look for on the lower time frame is you want to look for breaks. I'm going to put it here, breaks and retests. And you also want to be looking for fair value gaps on the lower time frame. So whatever lower time frame you use, whether it's the 5-minute or the 3-minute, which is what I use, you want to look for basically a fair value gap and a break and retest while this is happening. So this is going to be the major confluence, and then the other ones are going to be basically the lower time frame, the break and retest, and the fair value gap on the lower time frame is going to be that confluence that, hey, you know what, we're going to go down. It is the same concept with a bearish candle. Same thing. We have an ending of a downtrend, and then we have price engulfing all the previous candles to its left, and it creates that break of trend and whatnot. So now that we have that in place, let me just erase this. So now that we have that in place, the second candle that I look for whenever I'm trading is basically the tweezer candle. So obviously we have here the tweezer candle. I'm going to pop this open so you can have a better idea of it. So tweezer candles, there's two types of tweezer candles. You have a tweezer top and a tweezer bottom. Now these are basically printed at either the ending of a downtrend or the ending of an uptrend. If it's at the high, then obviously we're looking for bearish activity. If it's for a sell, we're looking for it at the high of market. So this is candlestick patterns that you want to look for on the higher time frame, at your real low or your real high to give you that confluence to get it. Now a tweezer candle, like I mentioned here, we have two. We have the top and the bottom. The one that is the tweezer bottom, it's usually an indication of bullish activity, and the tweezer at the top is an indication of a bearish activity, and it's basically created off of two or more candles that are basically identical in size, in wicks, and whatnot. As you can see here, same candle, same candle, same candle, same candle, and then boom, here we have that break of market structure, and then we have that change. We have that change of trend. If spotted at the top of an uptrend or at the bottom of a downtrend, you need to basically act accordingly to that pattern. So again, like I mentioned, a tweezer top is basically at the bottom of a downtrend, and a tweezer tops is the top of a uptrend, and it's usually a change of direction. So if you see it at the bottom, it's usually coming from a bearish previous price action to a reversal to bullish action. And the same thing for the tweezer top. We usually had bullish reaction to the upside. We create that two tweezer candles, and then boom, a change of direction to the downside. So that's basically candlestick pattern number 2 that I use, that has helped me a lot with my overall confluence whenever I'm basically trading. Let me remove this here. The third one is the inside bar candle. So the inside bar candle, I'm gonna pop it open here. Come here. Perfect. So the inside bar candle, I have here some notes so I can kind of let you know. So bullish is when it occurs at the bottom of a downtrend, and it's bearish when it occurs at the top of an uptrend. So again, I'm gonna basically lay this out for you. So with a bullish or with a pin bar, inside pin bar candle, essentially we have the mother candle, which is the big one, and then we have the small one, which is known as a child. Some people call it the baby candle. But essentially, you can see here, we have the big drop here, massive wick right here. And then what comes after that? We have a smaller candle right here. And then as soon as we create that inside pin bar candle, what happens, bro? We off to the races. Same thing here. We have that big engulfing candle here, the big bearish candle here, right at the top of this level. And then what did we create? We created a smaller candle here. And then what happened after that? Boom, a massive engulfing candle that took all of this dynamic liquidity that was basically built up here. So this is what I look for as well when I'm trading my real lows or my London lows and my London highs. So if this is created, it gives me that indication. You can see as well here, we have that fair value gap being built. Price retouches it up here, and then it continues the downside there. Even if you miss this big drop, you can wait for the retest. We touch the fair value gap right here. And then what happens? Boom, we dump all the way down. So it's about being able to react accordingly and being able to react effectively when you see these on the higher time frame. And again, you want to use these, bro, on the higher time frame. You don't want to use it on the lower time frame. You don't want to use it using the 3-minute chart. You always want to use the bigger time frame to help you out. Now, this candle here is called the doji candle. So this is basically when you see this, bro, you want to avoid the market. So this just basically lets us know that we have indecision in the market, effective price action. Like price is not going up, it's not going down. Usually we have these, and there's a lot of range in market. So obviously we had it being created here. Mind you, as well here. So mind you, bro, this is the 1 hour time frame. So basically, bro, we had 1, 2, 3, 4, 5, 6. We had 6 hours of choppy movement. And in the bigger time frame, it looks like, hey, highs, lows, equal highs, lower lows, equal highs. Like it looks like a smooth pattern, but on the lower time frame, it looks like this. And this is not a market that you want to trade in. So if I see this at my real high or my London low or my London high up here, I'm not going to trade it until we break this overall, choppy movement and we have a break of market structure like we did here. So whenever I see this, I instantly avoid the market because I don't want to get involved in any choppy movement. So this is another candlestick pattern that I look for whenever I'm trading. And again, higher time frames is where you always want to look for. So now the other one that I look for, bro, is going to be the inverted hammer candle. Now this is basically created off a bearish or bullish action. Usually with this, with the hammer inverted candle, it's formed at the bottom of a downtrend, which obviously is a switch from bearish to bullish. And if you see it at the high, it's a switch from bullish to bearish. In this instance, I was able to capture a bearish reaction. So what happened here? I'm gonna pull out my marker so you can have a better idea. We were on a complete downtrend here, right? Lows, lower highs, lower lows, like just creating that staircase bearish activity. And then, bro, right here, we created that hammer inverted candle. And then what happened? Price rips up. So like, for example, if I'm trading in the morning, bro, and I see this being created at my London low, I'm gonna be more enticed to catch a bullish reaction. And what happened after that? We had that engulfing candle that engulfed basically all of this, and then we had that break of market structure here, and then boom, again off to the races. So again, I use the higher time frame and the lower time frame as like a synchronized machine, so to speak, and it gives me that my proper entry. And probably on the lower time frame, what you would probably see is you'll see something like this, boom, fair value gap here, and then when we go back down, we have that retest, and that gives you that green light to take your buys somewhere here to the nearest level of resting liquidity, which would probably be maybe like up here. This will be near this. This will be a nice level of liquidity if you want to target. If you want to be conservative, it would be right here. So we come here and we target these levels here because it's a known level. This will be take profit 1. This will be take profit 2, and then maybe somewhere up here will be take profit 3. So those are the 6 candlesticks that I use on a consistent basis whenever I'm trading at the London lows or the London highs. I avoid doji patterns as well. So again, if it's a doji pattern, it's indication that there's indecision in the market, and I don't want to get involved in any position because it's essentially a ranging market or a choppy market on the lower time frame. On the higher time frame, you have those like a T pattern, which is like, again, it's an indication of a of indecision in the market. The engulfing candle is very obvious, which is we break, and it's a big candle taking all the candlesticks that were printed to the left, whether they're bullish, we're going down, and if they're bearish, we're obviously going up. I look at the hammer inverted pattern, which is basically this. If this prints at the lows, I'm confident that we're going to shoot up, and if it prints at a high, I'm confident that we're basically going to drop down and dump. I also look at the shooting star pattern. It's an indication that we are forming at the top of an uptrend, very similar to a hammer inverted pattern, but as it's for bearish activity. And then obviously we dump from that. Then I look at the inside bar pattern, which is basically we have that big mother candle and the baby, which indicates that when it occurs at an uptrend, it is bearish because it's the ending of an uptrend, and if it's on a downtrend, it's bullish because it is the indication of the ending of a downtrend, going to bullish activity. And then we have that tweezer candle, where it's 2 or 3 identical candles that kind of are side by side, usually the same type of length and body, same type of wicks, and then of course, if it's at the top, it's bearish activity after, and if it's at the lows, it's bullish activity after. Again, if you need the Candlestick Bible, let me know. I'm going to send you all of these examples so you can have them as well for your own studies and whatnot. But that's a quick breakdown. If you need more clarification, let me know, and hopefully this helped you out trading at the London high and London low areas, and what I look for specifically on candlestick patterns to give me the confluence on the higher time frame, and I just align it with the lower time frame.